You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are very excited to be back with this week's edition of the Systematic Investor series, which is our weekly ongoing raw exploration of the world of rule-based investing, and of course, where we also take some of your questions. And we're back to the normal routine. So today it's good to say good morning to you, Jerry, and good afternoon to you, Moritz.
Hi, Niels. Hi, Jerry.
Good morning.
So before we pressed on record, Moritz and I just returned from Miami. Actually, I returned yesterday, and Moritz came just right now, actually this morning. And we both experienced something as we were talking. We realized that both of our flights back from the US had been probably the most bumpy flight I've ever experienced. I mean, incredibly, 6-7 hours worth of turbulence, nonstop. And when you're sitting up there and it's pitch dark outside and you're thinking, are these planes, are they really going to stand up for this? And it kind of reminds me a little bit about, trend following and what we do, and where, we look back and we see, how bumpy the ride really is. Yet the methodologies, have withstood all of these events for so many years. But I don't know about you, Moritz, what you were thinking when you were sitting up there. But for me, it certainly was a little bit sort of déjà vu when I think about what we do for a living.
I wasn't thinking much. I was just trying to fall asleep. But good
Fair
analogy.
enough.
It's bumpy.
Yeah,
Yes.
yeah, exactly. Very bumpy. Anyways, obviously another interesting week. Maybe not so many movements per se overall. I noticed that our friend natural gas dropped 11%, so that was a bit volatile. The VIX closed down around, I think, 16, so that was the low for a few months at least we've seen. A lot of the financials kind of stayed within, at least for the week, relatively small ranges. Of course, the energy sector did well overall, up sort of 2-3% on most of the energies, and then we had on the upside, and again, I don't think any of us really traded, but it comes up on my screen, and that was lumber, 10% gain for the week. So yeah, still a few things happening in futures land for sure.
Not trading this. I missed it.
Yeah, well, exactly. Last year it was down 50%, and this year it's up a lot. So maybe we should all start looking at lumber a bit more serious. But of course, we're here to talk about what happened in our portfolios for the week and other good stuff. So why don't we come to you before the jet lag sets in, Moritz, while we still have you right awake? Tell us a little bit about your week, other than the social stuff that went on in Miami.
Yeah, that was good.
That was good, yeah.
The trading, well, I don't want to say it was bad. It's just, unfortunately, another slight loss for the week. Not much, close to 1%, but still a loss. But accompanied by quite a few changes in positions. Remember last week when we spoke, I was still saying I'm pretty much short the equities across the board. That has now changed. I have some long positions again, so it's more of a mixed portfolio. More short in Europe, a bit longer in the US and in Asia now. Energies, short natural gas.
Yeah.
And got longer on crude oil, longer on gold and silver, and much longer, believe it or not, much longer on the bonds.
Yeah. Interesting.
So, yeah, a bit of things changing. And, let's see what happens.
Yeah, I mean, we saw something similar. We actually had a slight positive week on our side. But in terms of the other things you mentioned, very similar. Poking around neutral to the long side on a few select equity markets now. Still short in Europe, as you mentioned. Fixed income, definitely the best sector for us this week. Very mixed bag in currencies. A couple of ones did really well. A couple of them did pretty poorly. And then there was also one or two, I think it was the lean hogs that did well for us this week. And then the rest was pretty quiet. I agree with you on the fixed income side. I mean, it's incredible what we can continue to squeeze out of these low interest rates still. I think in particular JGBs did quite well on our side. But other than that, not any major changes to positions. So all in all, a kind of a quiet week when we tally up the P&L, but with a few changes underneath, I would say.
Mm-hmm.
What about you, Jerry? I mean, you may have seen the same things in the overall markets, but of course, we are always very interested in finding out how the single stocks are behaving.
Yeah, another good week to not be net short stocks. We have mostly longs, small, not a big position. Some of our stocks don't look like the S&P chart, and some do. So we have a small short and bigger longs, but overall not much commitment there. So it's nice to have sometimes have a non-committal positions until the major trend looks fairly obvious. And listening to you guys, it just hits home that we trade so much different. I mean, I know that some of the positions you have that you mentioned, or new positions, I'm not even close to getting long or short those. And so it just shows, that different time frames or different ways of looking at the markets can produce quite a bit different temporary positions. I think we'll all be on the same monster major trends, but a done plus Chesapeake investment would look really good. Positive expectation all around, but different ways of handling the markets and trading certain markets. I don't think it's too late to get into lumber. I'm just looking at that chart. It looks fine. It's barely off, kind of rallied from those lows. We look at these markets in terms of VAR or ATRs. And so the large numbers that you can get from looking at percentages can be kind of misleading in the sense that it's sort of turning into an almost long trade for me. So it's not too late, but it could be one of those Hotel California markets where you can enter, but you may never leave. So we've always got to be concerned about the ability to get in and out.
Indeed. Absolutely. Yeah. I mean, and as you say, I mean, that's the beauty of it, right? And that's why, one trend follower isn't enough. I mean, you do need to have a few of them because systems can be quite different. And I think that, obviously when you come back from a conference and you talk to a lot of investors, one of the things that often come up is really the return dispersion among managers and how that makes it harder for the investors to figure out who to allocate to. And of course, in sort of the good old days back in the 90s, it was true, I think, that if you knew what John Henry or Chesapeake or Campbell or all the names done, what they were for the month, you kind of knew roughly where the whole industry was going to be. But that is not the case anymore. There's a lot more going on behind the scenes, which is good. It shows that we are all innovating to some extent.
And I think it's good that if you trend follow medium to long, and you trade a lot of different markets, long and short, whatever you throw up there, it's probably going to work eventually. It has worked. I think when we look at different time frames on our side, everything works, and they make about the same amount of money. And so that's good. That's what we kind of got a very robust system. Now, not every year. Our system 1 may underperform system 2, even though the parameters are unfortunately close. They have to be sort of close because if they're not close, it's not going to work as well. So it's kind of like the stock market where they say, buy and hold, and this is the returns you get. Well, as we talked last week, in a lot of countries, they can no longer say that. So it's getting narrower and narrower. to where maybe it's just the U.S. that they can cherry pick and say, oh, buy and hold. It makes 8% a year, and that's all you need to do. And so maybe it'll just get down to the S&P only, and you'd have to leave out NASDAQ and Dow. I don't know, but I think I'd rather be in our situation where it's hard to find something medium to long term, currencies, commodities, stocks, bonds, long, short, that doesn't do pretty well over a 20 or 30-year period.
Very true. And the other thing, and it's not just really model by model. There certainly can be differences on our side between our two main trend models, but also markets by markets. I mean, I think we are of the opinion that over the very long run, I mean, all markets should give us the same return. Yet, of course, a lot of people tend to sometimes just decide to exclude certain markets, maybe because they haven't performed for a few years or, for other reasons. And that's where we certainly truly believe that there's a lot of value in the fully diversified approach, maybe on the expense of not being able to manage, $5 or $10 billion or more, but still, if you want to have the best overall diversification, you definitely need some of these commodities, as we can see from just talking about some of the big movers last week. I mean, nat gas and lumber and stuff like that. I mean, there definitely are trends in those markets. Anything to add on your side, Moritz, before we jump into kind of what happened in the news and so on and so forth?
Couldn't agree more with what you said, and just remembering one of the meetings I had on, I think, Thursday. Not going to mention the name, but it was a trend following CTA. And just like you said, Niels, the markets have the same expectations, the trades have the same expectations. And as a result of that, we trade them all in the same way. And I would have thought that should kind of be like, the default common knowledge, so to say. But I met the CTA, and they very deliberately traded different systems, different parameters on the markets. So they had a system that was called Select, and then that Select system will only trade certain energy markets in a certain way. And then they have a Select Plus system, which trades, some of the ags in a different way. It's just, interesting, but not for me.
It's really, we're going backwards, research and evolving away from the truth. It's just really kind of funny when people will say, I think we had a question a few weeks ago or last week, what is your edge? How would you describe your edge?
Right, yeah.
It's very sad. I trade all markets the same way. I have a fixed universe. Oh my gracious. I mean, how can this be the case? How can this not, these common sense, these normal statistical concepts of needing to trade all the markets the same way, needing to have a fixed universe, how can we even claim that could be such an edge only through the mistakes of others? It's sad. 1983, you would think some of those principles and trend following commandments are embedded in everybody's knowledge, but it's just a sad situation. They're not.
They're not.
Well, sometimes the most obvious isn't what people gravitate to, right? Because they think it's just too good to be true or too simple to be good. The hard part is actually to do it and to stick with it and to defend it. Yeah. Interesting. Now, what about social media this week, Jerry? Were you active on social? We were probably not paying too much attention, Moritz and I, since we were running around, putting our best foot forward in Miami. But what happened in that area?
Not a lot of great stuff going on this week. I certainly could figure out a way to take seemingly trivial and ideas and turn them into good tweets that people kind of like, because I have trend following followers and they like to hear about trend following. So by far and away, the biggest tweet was from a Forbes magazine article, just talking about trend following and how great it is. Just a cheerleader type tweet. Quote, "It shouldn't work, yet the record is robust. The momentum factor has proven robust over 200 years, out of sample and across markets and geographies. roughly it may deliver a return about 10% higher than the market per year based on history. So this one just skyrocketed to number one. Not sure why. Just Jerry has given us some encouragement in this sort of bad period for trend following stocks or diversified or whatever. So
what were they basing the article on? Did they have a particular piece of research they were referring to, or?
Yeah, there was some research and somebody's research. Okay. The 10% higher than the market per year. I'm not sure. Maybe I should be more responsible and confirm some of these numbers and some of these ideas people put out. It seems a little high, but yeah, it was encouraging.
Absolutely.
Encouraging piece.
Yeah. Great stuff. Yeah. What else were liked and loved in social media land?
Well, particularly one of the things that kind of gets me going is when I perceive that people are sort of coming up with ideas that are a little dubious, but have a tendency to reinforce their own business model. I guess I could be accused of the same thing maybe, but yeah, the idea back again was this silly idea about market timing. I never really read too much about market timing. I don't even know what market timing is necessarily. I know we've talked about it. It's I read it mostly from people who don't like it and who don't agree with it. I never really see too much like someone advocating market timing. Once again, I'm not sure I know what it is. Right. It's not trend following. And this is the point I was trying to make. Market timing does not equal trend following. But I think these people, they know that, but they seem to not be bothered by the confusion that they sow with these ideas. So I think it's, and I think, one of the, even anything other than buy and hold, one of the frequent claims is, well, even if you got out or if you follow the trends or if you did the market timing thing, when do you get back in? I mean, who knows? How can you figure it out? So don't even bother. So I think now is a very good opportunity to sort of look at that. Like, unless you stayed completely long through that big sell-off at the end of the year, you are very confused now. I mean, I know I'm confused. Yeah. And all I have is to follow my systems. I have an edge because my stocks, I look at the single stocks and the chart patterns, the charts look much different than the S&P. And so I can just follow the system, buy the breakouts, and stay short until those turn into losses. So I know what my game plan is, but I do think that unless you're just totally buy and hold without any regard for risk control and reducing positions and getting in line with the trend, you would be very, very confused as to how to get these stocks back on. When should I put on these positions? How should this go? And so we have the answer to that, which is available for everyone, which is looking at some decent trend analysis for all the stocks.
I mean, I think that's a great point to bring up because, I mean, there's one part of it that just talks about, market timing from when do I buy and sell these stocks, but just also in general, if you, certainly a lot of the people that we met at these conferences, when they talk about trying to time trend following, I mean, when should I buy? When should I, get out? And we actually leading into the conference, did an analysis just looking at every single major drawdown as defined as more than 25% in our fully leveraged program and minus 12.5% from the last peak in our institutional version of it. And the last time we actually updated this study was in 2012 because that happened to be the last time we were in a drawdown of that magnitude. And you look at these recoveries. We've only had 11 of these in 35 years since this particular strategy began trading. So it's like every 3 years, but in this case, we've had 6 years in between. Maybe because some of the improvements we've made, I don't know. But it's just so interesting. I mean, the recovery periods, how quickly they can be, and so it's so difficult, I think, for investors, especially with a strategy like trend following, to even think about timing it. And we certainly on our side, gave up many years ago trying to time even our own type of investing style. So I don't think any investors would have an edge in doing that, except for the fact that I always think that it's a better idea to buy these strategies in a drawdown if you believe in the long-term track records, of course.
That's what I wanted to add with timing. It's probably, odds are it's a good moment in time to buy done.
Yeah, I mean, any trend follower that's been in a drawdown for a while. I mean, in our case, it's only been a year, so it's not even a long drawdown, but it's actually the average. I mean, if we look at the 11 previous drawdowns or 10 previous drawdowns we've had of this magnitude, it's exactly 12 months on average. Now, of course, some were shorter and some were much longer, but on average, 12 months. And then if you just look at what the recovery has been, say 3 years after your drawdown finishes, I mean, it's extraordinary how these strategies tend to recover.
So much to say on this, but one of the things that I use as one of my logical reasons not to trade indices is that you're trying to time another system, because the S&P is a system. It's rules-based. And my opinion, that's why it does so well, because it's even if it's a silly bunch of rules, not a sophisticated rules, maybe it has a little trend involved in it. It's adding to stocks that are doing better. It's reducing its weighting of stocks that do poorly. It still is a systematic approach, and it beats discretion. It's hard to beat it. But once again, I think to some degree it is trend following another system, and I think, I can't stand it. But I think we did a little bit of research on our track record and other famous, or I'm not famous, but famous CTA track records.
Of course you're famous, Jerry. Come on.
And it just confirmed that there was no advantage waiting for drawdowns, waiting for negative months. It was always the right time to buy. It's a positive system. It's a positive game that we play. And so you should always be buying. Maybe base your purchases on your own personality, $1 million a month for 12 months rather than all your 12 million at once, or whatever your personality is. But mathematically, it's always a good time to invest.
Yeah, it's funny when I joined Dunn, one of the things that Bill Dunn, the founder, would always be quoted for and say is that, of course, the best time to invest in trend following is at the bottom of a drawdown. The second best time is today, and that's exactly the same as you say. I mean, you just have to have some of it, and don't try to be too clever about your entry point.
And the only logical reason to not do that, it's perfectly reasonable, I suppose, is just to say it's no longer a game.
Right.
It's no longer what it was. That's good. Make that claim, have your proof, line it all up, tell us why that's the case. And this time is different. That's fine. But that's the only thing that you can say.
Yeah. Absolutely. What else did you have lined up for us from your tweets?
Well, I sent you guys an article from Hedge Nordic, which I haven't had time to really go through and like I'd like to. So maybe next week
we should all try and
hit that harder. Yeah. There was one quote in there that I really liked. Of course, I'm beating a dead horse. Trading the stock constituents makes more sense than trading indices. The dispersion you get from looking at trends at an industry level, sector level, or factor level is greater than an index. We really push where we think there is diversification to be found. Yeah, exactly. I mean,
who was that? Was that Harold who had that quote?
I don't think that was Harold. Okay. But yeah, it's more on that. Yeah. I love these hedge fund roundtables. Yeah. I'd like to be in one of these days if anybody is out there. Sure. I have been invited, but hopefully one of these days. It's like our little roundtable we have every week. Yeah. And
maybe we should do a trend following online summit, and we should get a lot of our peers on the call. We can do this.
I like it. Yeah.
Okay. Great stuff. What else?
Yeah, just one more. I'll just sort of piggyback on what I think Moritz was saying earlier today about these markets having the same expectation. And trend following is this magic formula that takes sort of buy and hold markets that don't really maybe look good on a historical basis and then turns them into profitable markets, and you get the diversification. So one of my friends had something on his website, quote of the day. And you're like, okay, cool, let's hear this. Gold pays no dividends or interest. The only way to value gold is to measure its supply and demand. This makes gold a commodity. Some say gold is a hedge against inflation. It is not. I mean, come on. So I was just thinking that this is a really slow day, and that's the best you can do. Your quote of the day is bad-mouthing poor old gold. But it's like all commodities. When you trend follow them, they had profits, they had diversification. It's magic. Well, it's not magic. It's just a way to trend following allows maximum diversification. Does not matter if those markets were historically profitable, buy and hold. Does it matter if they're out of business? Does it matter if they no longer exist? Riding the trends is a safe way of getting more diversification into your portfolio. And I think we just got to continue to, or let's get some good questions in here and say, I know that's not true, and here's why. Please defend yourself. One way or the other, I'm going to keep preaching the same thing.
Absolutely. Now, I'm going to go over, we have a few questions, which is great. And by the way, if you have a question, do send them either by email to info@toptradersunplugged.com, or you can tweet one of us. Personally, I have to say, I don't follow Twitter so much, so I might miss it. So if you want to make sure, then send it by email. They will definitely make sure we get it on air. But while we do the questions, maybe, Moritz, you can think a little bit about sort of your main takeaways from the conference in Miami, and I'll do the same, because I think it's always good to give a little bit of sort of instant feedback to people who follow this space, as our memories are still relatively fresh on what happened. Now, the first questions, we have questions today from Samuel, from Michael, and from Francois. And Samuel, first of all, thank you very much for your kind comments. They are definitely noted and appreciated. I'm going to go straight to the first question you had, and it goes like this. My main question this week is regarding costs. Given a certain level of volatility chosen or contracts traded over time, perhaps round turns per million, what is a standard CTA cost hurdle rate in order to turn a true profit? I'm not interested in the cost of running the business, but simply the trading cost based on execution and brokerage implementation. So let's talk about cost. Incidentally, something that I spent a little bit of time also talking about with our team when I was in our offices before I went to Miami. So anyone want to venture? Moritz, do you want to venture in and talk a little bit about what costs to expect, execution, clearing from the type of trading you do on a yearly basis?
Yeah, sure. Very happy to do that. So the way I look at costs is you have those hard, unavoidable costs, which are execution commissions, clearing commissions, and exchange fees. And the way we trade with futures contracts, that's a cost per lot, right? So that is a cost that will scale with your round turns per million, your trading frequency, and all that. And then you have a, kind of like a soft cost block, which is market impact, slippage, bid offer, those type of things, which by order of magnitude is much larger than the execution, clearing, and exchange fees, because if you're always crossing bid offer, you're paying a tick, maybe sometimes 2 ticks, you have slippage and market impact, that can easily be like, $20, $30, $40 per lot. It's not that in my case, but it can be, right? And sometimes even worse than that. So the way I trade with the volatility that I'm looking at and the trading frequency, there's about a 2.5% per year impact on the portfolio.
Great. And that is roughly to give maybe an answer to, and of course you have more volume than Samuel will have, but in general, what is your expected cost per lot? And you don't have to mention your specific cost, but what do you see in terms of ranges of costs for contracts nowadays on your side?
The execution commissions, they may be, between 50 cents and $1.50, sometimes, a bit higher, sometimes, $2.50, put it that way. Clearing is another buck on average, and then maybe 50 cents to $1 in exchange fees.
Yeah. So
it just depends on your brokerage relationship, how much you trade, how much volume you're putting through, the way you trade, whether that's electronic, whether you're using the broker desk, and you submit orders to them for them to execute. That will all have an impact.
Yeah. Anything to add to that, Jerry?
I think it's very important to track the cost of the theoretical and the actual. That's what we call it, and we track those costs for 30 years. And I like to do this sort of negative performance table as it relates to my cost per month. The computer said I made 3%, but I only made 2.9. So let's keep track of that and see what the slippage and the commissions and the execution cost us. I look at it on a per trade basis as well, in terms of the ATR. So for me, everything starts with the ATR, my average win, my average loss, my average trade. The cost of trading is a quarter of an ATR, a tenth of an ATR, and sort of build all of that in and your research, and then hopefully you build in enough with the medium to long-term trend following that most of us do. We're going to look pretty darn good as compared to shorter-term trading or trend following. And I'm very impressed and amazed by short-term traders who have to absorb this cost on every trade. And if you took out those costs, we could all make a ton of money probably trading very short-term. It gets really dicey when you add them back in. So congratulations to the short-term guys who can not only make profit, but they have overcome a higher hurdle than the long-term guys.
Yeah, no, I think those are great points. So to answer your question, Samuel, on our side, we as Jerry alluded to, there are different ways and different jargon in our industry to determine how active you are as a trader, and the term that is often used is how many round turns do you do per $1 million you manage, and a round turn is basically a buy and a sell, so an open and a close of that contract. That's what I refer to as a round turn. And so in our case, as a long-term trend follower, we probably don't do much more on average than 1,000 round turns per million per year. And that means is like Moritz was saying, if you're paying roughly $2.50 for a buy and $2.50 for a sell, that's $5 per round turn. So in our case, $5 per round turn, 1,000 round turns per year, makes our sort of commission burden on a yearly basis about 0.5%, so 0.5%. Is what we have to absorb in terms of pure execution and clearing cost. Then, of course, there are some other costs, as Moritz was saying, and you can start to calculate as best you can in terms of slippage, et cetera, et cetera. We don't have a lot of slippage on our side. We have an incredibly experienced team of traders, so that helps us to keep slippage down to a minimum. But great question. And by the way, I happened to meet someone in Miami who had been on the podcast a while ago, so a manager in the short-term space, and he's doing 25,000 round turns per million per year. He's still making money. So as Jerry says, great job to be able to do that. But in his case, if he can lower the cost of execution and clearing, it has a huge positive impact on his net return. So I'm sure there's a lot of pressure on that side for the short-term guys. Samuel has a second question, and he says, in listening to the podcast for almost 5 years, so you must really have been one of the first listener of Top Trader, so I really appreciate that, Samuel. Now, a frequent and confident saying is, your biggest drawdown is always ahead of you. Why is this the case, and common belief among trend followers? Do you believe this to be true of all investment strategies? Is it simply a function of uncertainty and preparing the worst that we should believe in this statement. So I'm going to start with you, Jerry. It is true. We often say your worst drawdown is always ahead of you. Why do we do that?
Probably to be ultra conservative risk managers and not to kid ourselves that the back test is gospel and this is what it's going to look like. And as soon as we tick below the worst drawdown on the back test, we know that the system is no longer good. We can close up shop. We're done. And I think it's just the way the numbers work out. There's a lot of future ahead, and we may have a worse drawdown than we've seen historically in the back test or in our experience. But I'm sure that someone out there had the worst drawdown their first year trading, down 75%, and came back, and they probably will never have another drawdown that large. But it's just a good way of being real about what to expect from the markets, and that is you don't know what to expect, so it may get worse.
I have two follow-up questions for you, Jerry. Well, one is more a comment. You talk about drawdown. In theory, we could talk about drawdowns in equities, and I remember that Amazon started out its life with a 94% drawdown from its high. So you kind of hope that they definitely don't have their worst drawdown ahead of them. That would be very painful. But secondly, and more serious, could the same be said about your best year? Could you say the same thing that, theoretically your best year should be ahead of you as well?
Yes, I think so.
Yeah, why not?
Absolutely.
Notwithstanding the fact that history, it looks like for most of the traders who've been around a long time, CTAs and the famous hedge funders, they, as time goes on and they raise more money, they've had tremendous success, 90%, 100% years, whatever. I had a 60% year that they build these businesses and reality kicks in and they say, let's try to make 12. Let's don't have the drawdown. So it's a business decision, but from a numbers point of view, return risk, there's no reason we can't. And I think we will. I mean, we'll end up, as long as we stick to what we know, we will end up being repaid handsomely for these bad performance years in the future. I firmly believe that we'll get back to more of a normal trailing 12-month return.
Yeah, absolutely. What about you, Moritz? Anything you want to add to this?
Yeah, I agree with that. I think all the best and all the worst things are ahead of us. Your best day, your worst day, your best month, your worst drawdown, your most successive up days, most successive down days. Reason being is, we have a limited data set, a limited sample size historically, but theoretically an infinite sample size going forward. Now, we're not going to be around forever on that planet, right? But if you just assume that you're going to be trading that for another 1,000 years, then it'll become almost a statistical certainty, not a guarantee, it's, likely that you will have your best year in the future and you will have your worst drawdown in the future. And this is why I say it. Kind of like also then portrays that conservative message. Most of the time it's only about the worst drawdown. Nobody asks about, do you think your best year? I've never heard that question, actually. I'd like to hear that, but never came up yet. It's always about that worst drawdown. So yeah, it's probably going to be in the future. And it keeps us attentive and good risk managers. But I can only look at that from, in that statistical sense that I just described.
Given the fact that Jerry often tweets that we should love our losers, that must mean that we also have our best drawdown ahead of us, I imagine. Now, from my side, I would just add, Samuel, that one thing I noticed, and I completely agree with both Jerry and Moritz on this point, but the way to look at it, I mean, you would think, of course, that look at, a firm like ours, we've been in business, this is our 45th year in business. So you would think, and we've had a big drawdown about 12 years ago, and you'd like to think that was the worst drawdown, or you'd like to think you're never going to get back to that level with the innovation that you make and so on and so forth. And we're not a firm like, as Jerry was explaining, some firms tend to lower their leverage so they can manage more money and so on and so forth. But because we don't collect a management fee, we're not in the business of being asset gatherers. We're here to make money for our clients, first and foremost. And but I did notice that back in 2013, many of the firms that we often talk about, had been around for a long time, 20, 30 years. But 2013 came around, and a lot of the worst drawdowns that these firms had seen over 20 or 30 years actually was breached, and by quite a big margin. In some cases, an extra 50% more in terms of drawdown. In some cases, an extra 100% more. So there is some truth to this, that you should always expect that it could get even worse. But I also agree with everything that's been said, that we should also expect that we could have our best year ahead of us. And of course, with innovation, you would like to think, and I think that's a fair expectation, that we do learn and improve and become better at managing the downside, because that's one thing. As a trend follower, we don't control the upside, so we don't worry too much about how much money we can make, but we do to some extent control the risk. And that's why you often hear Moritz and Jerry and I talk a lot about the risk management side of what we do, because that is where we have some level of influence. And of course, we hope that translates into quote unquote better drawdowns than what we've seen. But great question, very relevant. Thank you for that, Samuel. Then we have a question from Michael, and he says, new question for the podcast: how much has your parameter set of your trading system changed since you started your careers? How much does it change during any year, or does it always stay the same? Do you experience that parameter sets and trading systems themselves are sometimes trending, meaning there are years or months when one system or set of parameters performs much better than another, and then it performs worse again? And what do you do about it? So I'm happy to kick this one off, because we actually did a little bit of analysis on this. So if we look at and thanks for the question, by the way, Michael. When we look at generic trend following systems, so not something that is 100% identical to what we do, but pretty close, we actually went back 28 years to see what the optimal look back period would have been. And it is quite extraordinary how different the optimal look back period for 1 year to the next. You can have years where your optimal look back period is 40 days, and you can have years where it's 240 days, and anywhere in between. So yes, I mean, parameters and settings and lookbacks. If you had the foresight of trying to get it right every year, you would see enormous change. Now, clearly, we don't have that benefit to do so. So I think all of us, to some extent, try to be somewhere in that range of where there is a kind of a cluster of profitable parameter settings for each of our systems. Now, this is not, and Jerry and Moritz can explain how they do it. On our side, what we do is we allow the models to have a bit of a playground to play in, meaning we don't say it has to be just 150-day look back period as one of the parameters. We actually allow the model to change slightly over time, and this is something we've implemented since 2006. Does it add value? We believe it does. But it's not like the whole model just has one time frame. We actually use multiple time frames within each model, so that there is so we're trying to catch, some good look back periods, for example, in this case, but the same with other parameters every year, not knowing where it's going to be. So that's one way of doing it. I'm sure there are other ways. And so, yes, to answer your other question, do these things change, and do they sometimes trend? I wouldn't say they trend, but they can certainly move in certain directions. If your longer term timeframes become more profitable over a certain period of time, then in our case, certainly we would gravitate towards that. Vice versa, if it becomes more medium term, we would gravitate towards that, but over time, not over a month or two for sure. But that's how we do it, and I think most managers, have more than one or two or three timeframes. Although we started out back in the day with just using less than a handful different parameter sets per market. So, how about you, Moritz? How do you deal with timeframes and parameters?
I have many different timeframes, certainly more than a handful, but they do not adjust or amend themselves automatically. So I will have to do that manually, look at the systems, and I would have to change them. Now, what I would add is that I can't remember the last time I changed the look back period. I mean, the way I came up with them is I wanted to be diversified across a number of different timeframes. I don't want any of those timeframes to be over optimized, like on a heat map, and just pick the best performer there. Kind of like has to be in that sweet spot. But for me, most of the work and most of the most important thing, I believe, is to have good exit strategies. Getting into the trend at a certain point in time, that we all do that. There may be small deviations and differences how we get into the trade. Maybe you get triggered by a high or get triggered by the settlement, then you get in with the next open or maybe with the next close. All of those kind of like different entry methodologies, they may have an impact. I think there is reason to diversify across those as well. And then the most important part to me is the definition of the exit strategies, of which there could be a couple. And I guess this is where most of the parameters have changed ever so slightly, maybe in the last couple of years, with some new ideas, some new beliefs in risk management. It's around that where I see more dynamic.
Great. How about you, Jerry?
Well, I think nothing's more important than getting in the trade. You can't miss a good trend. So whatever your parameters are, make sure that they can eventually be satisfied. So you don't miss a good trend. And as soon as you get in, you're waiting and waiting, it'll turn into a loss, but you still got to get in. Definitely from the turtle days where we traded shorter term, the most important thing we did was in early 2000s, recognize we had to continue to trade longer term and make our look back periods longer term. So that is the biggest change that we've had to go through. I like what both of you guys said. I agree with both. I have to figure out how I can agree with both and then implement both at the same time. I am more aligned with Moritz, but I like, as I've said before on the podcast, I like the systematic way of choosing the systems. And I know that if I implemented that sort of approach, I'm pretty sure my parameters would change almost never. But I do think that is a good way of doing it and looking at it. I think the correlation amongst the different parameter sets and systems is misleading sometimes in that we're all going to be short crude in 2014 at 90 on the way to 20 something. My systems, every one of them, and every one of your systems. So at some point, the correlation is really reaching 80, 90%. We're all correlated because we're all on that trend and it's kicking ass. But then as the exits happen, much different P&Ls. As it rallies, I get out of some and then it goes back to the lows again. So that is something to keep in mind, that when we say that all the systems make the same amount of money over time, they don't make the same amount of money on all the big trades. That's why we think the exits are so important, to diversify and not go all in for it. One exit that can make you look like a hero or make you look not so good. So diversifying those exits is pretty important.
Yeah, I think those are really, really important points, and I also agree with what you both of you say. I will just add, Michael, to the question also, is that on our side we use two different approaches within trend following. So we definitely see as Jerry explains, differences in in the short term between the two models in a certain market, et cetera, et cetera. So that's another way of diversification to be aware of. But our experience is also that entries are relatively easy to spot, whether you use moving average, crossover, breakout, time series, momentum, whatever they're called. But how you get your exits really determines how much of the trend you can capture, and so they're super important to work on those. But thanks for the question, Michael. Appreciate it. Final question for today is from Francois. Another question from Francois, and so thanks for that. This is a question that might be a little bit difficult for us to answer, but anyways, we will always try. The question goes like this: in the world of systematic trading, there is one company that inspires admiration, even though it is very difficult to understand what it does. Yes, I'm talking about the mystical, I should say, the mystical Renaissance technologies. Could you guys please share what you know about RenTech? I have to say I don't know much, so maybe I'll pass that straight on to you guys if you've come across. Well, what I will say, Francois, to this question, a few years back, so obviously they have the Medallion Fund, which is the one that I think most people refer to, even though it's not really open to investors. They're now managing their own money, and by the way, there's often been talked about the issue about fee pressure on managers. But I remember back in the day when it was still open to new investors, they were charging 5% management fee and 46% performance fee, and they still had no problem in attracting investors because, of course, investors were interested in the net return. So just something to think about there when it comes to fees. But what I will say is that from memory, and I have not looked this up, but they launched a quasi trend following type fund a few years ago. And if memory serves me right, I don't know that their trend following fund is any better than what the three of us are doing and many of our peers are doing. So I think there's a big difference when you talk about RenTech, if you talk about their Medallion Fund or you talk about their trend following approach. So I just want to throw that in there. But Jerry, Moritz, what can you share about the amazing RenTech?
Not much. Must agree that I find them amazing. They're not taking anybody's money. That's the problem. But I mean, everybody that has worked there is, as far as I hear, contractually prohibited from speaking about what they do. So it's kind of like a very closed box, difficult to get a handle on what they're doing. From the filings, and every once in a year or at the end of the year, there's kind of like an update. Somebody spoke about the performance. They're almost always up. I think they're always up. And they trade long short stocks, given their background, heavy in math. I just, it's speculation on my part what they trade. It's not trend following. Something else. I just don't know. But it's great.
Yeah, I mean, I assume it's some sort of market making with futures, cash, and options, very math intense, and good for them. It is interesting. I do remember investing personally in, I believe, the funds that you mentioned. There was a Renaissance Institutional Futures Fund, which no longer exists, I believe. And there is a Renaissance Institutional Equities Fund. I think I was invested in both. I'm no longer invested in the Institutional Equity Fund, and it was more of a normal, systematic, longer-term approach than the sort of Medallion, which is. I do remember one fun story about that. Those guys are just on a different planet than trend following. And I do remember a couple videos on YouTube recently where Jim Simons was really funny. I sat down with some guy to talk to him about his methodology and the math and all that stuff. And Jim explained a little bit how it works. And the guy goes, okay, I get it. I understand now. And Simon said, no, you don't. You don't understand at all, because there's only like one other person in the world that really understands what we do. So I thought that was pretty funny. I know he's on record as saying trend following doesn't work anymore. I took that to kind of mean that maybe risk adjusted, the Sharp, is certainly below what Medallion does. So why bother? But I do remember another funny story. When I was invested in the Futurist Fund, there was obviously a majority, I think, trend component, and there was a mean reversion component as well. And they had a month where they lost a substantial sum of money, more than they wanted to, and it was due to this mean reversion. And their explanation I remember was, well, we just have to expand our parameters more. I think that's just kind of funny how it always works. Your biggest mean reversion problem is always in the future, kind of like our biggest drawdown is always in the future. If X happens, we will do a counter trend mean reversion trade, but then you have to always leave open a possibility that you may have to change that parameter in order to get that same mean reversion profit. So one of the big advantages of trend following is we don't really have to look at the markets in that way.
Absolutely. And I was just Googling while you were talking, Jerry, the Medallion Fund, and there's an article here from last summer, and it says the Medallion Fund, available only to Renaissance employees, has generated returns about 40% a year since inception in 1988, and that is after a 5% management and a 44% performance fee. So, I mean, I would say if you're an aspiring trader and you're good at math, you should get a job at Rentech just for the opportunity to invest in that fund. That should secure your pension, without having to do many other things. Great stuff. Moritz, a week in Miami, busy week. Well, you were in New York as well. So, but Context was one of the conferences we both attended. Comes at an interesting time after a difficult year for many alternative strategies. What was your takeaway?
So the broad takeaways, and I was thinking about that, is it's not all doomed for CTAs. That's the positive thing. After 2018, you may have expected people to be completely bummed out about it. I've heard a couple of times that this is now the time to hold on to it, given people's expectations about future developments and economic developments, geopolitical developments. None of us know what's going to be coming down the pike there, but they're holding on to it. That's what I've kind of got the feeling. What I also observed is that there's a lot of emerging managers still getting into the space, and there's many more professional seed firms working with those. So I see a lot of activity there. So if people have a unique strategy, something that has a great edge, is different to existing things, I believe this may be a good time to get them up. And I've heard a couple of times it's like with respect to all the, say, generic, naive, smart beta, factor type driven strategies, kind of like got the feeling that people think, well, that's a bit overdone, that's over, and maybe traditional active management is due for a comeback. I'm not sure about that, but that's what I've heard more than twice.
Good takeaways. Thanks for sharing. I mean, I think my takeaways were a couple of ones. So I had the opportunity to also do a podcast recording while I was there with two of the largest pension funds in the US. So people should definitely look out for that interview when it comes up in a couple of weeks. But I think together they have almost $400 billion or $350 billion under management, and a sizable allocation to alternatives, including CTAs. And I was frankly a little bit expecting some negative voices from them, given the challenges we've seen in this space in the last 10 years, really, compared to the traditional space. But it was the complete contrary. They were incredibly committed to having these strategies in their portfolio. They fully understand the value of them. They fully appreciate why 2018 wasn't a good year. It was not expected to be a good year when you look at what a trend following system is doing. So I thought that was very, very, it was very good to hear that there are investors out there who, understand perhaps the strategy like we do in that sense. So I think that was interesting. I what was interesting that also came up during my week in Florida meeting generally investors was a lot of them, because there'd been a lot of talk about smart beta products and low fee products, flat fee products. The overall conclusion from many of these investors was really that where they get their best performance is still from the managers that charge full fees. And I think that's another interesting conclusion, which may not ever get to the press and get the headlines, but a little bit like back to the medallion, where you're getting a fantastic return despite paying, fees that dwarf our fees, right? But still, the managers who know what they do and continues to put the numbers on the table, why should they not be deserving to get their fees? We can discuss the shade of fees, whether it doesn't have to be necessarily the way it was in the 80s, but paying normal fees is something that certainly those investors that I came across, said that that's actually also where they get the best performance. So I thought that was an interesting takeaway as well. And overall, a lot of people felt that, sure, I mean, after 10 years of QE, where you understand that drives up traditional asset classes like equities, like bonds, what if we're going to have 10 years of QT or Q something else or whatever they call it, but just the kind of the opposite environment? Why wouldn't it be that what we do could be the best performing part of your portfolio for the next 10 years if you have, essentially flat or maybe even negative returns in the traditional assets. So I think there is this general openness. I think investors have become very well educated in many cases, and I don't mean broadly speaking, but the people who really are interested in our space, I think they've done a great job in educating themselves as to what role these strategies should play in the portfolio, and I see a lot of support from their side to this space. So that was some of my key takeaways. Of course, another key takeaway was, of course, I had a chance. We've often mentioned, we've mentioned George a couple of times for his questions on the podcast and his contribution to creating these minute markers on that's on the website. So it's easy for you, the listener, to find out what we're talking about in each episode. And I did have the pleasure to meet George in person, so that was another highlight from the conference, of course. So great stuff.
I wouldn't be right if I didn't sort of dissent a tad in an expected way. That anybody who's watched the podcast knows that I would dissent. Our role, I would hope that over time our role would change, and it would be to manage 90% of the money, not 5% of the money, and that we would take the markets and the systems and the risk control and the inherent qualities and characteristics of trend following into the stock part of everyone's portfolio, and that people would understand that this is the only responsible and way of going forward, and having a portfolio dominated with long-only passive buy and hold traditional methods of dealing with the stock market, and 5% allocated to what we do is not the best way to go forward to preserve capital and make a fair sum of profit. So I would hope that somehow magically over time we would change our failed marketing strategies that have been around in managed futures since I began in the 80s, into something that's more real and more people need what we offer. They need the real crisis alpha is trend following your stocks.
Absolutely, and I think that's actually something that did come up also at the conference, and that was that people were a little bit concerned, and I have to be careful here because the person who came up with coined the phrase "crisis alpha," I have an enormous respect for, and I like her a lot. But there were some concerns that when people hear this thing, crisis alpha, which is now associated with trend following and managed futures, that people don't fully understand perhaps what that means, because it doesn't mean that every time there's a crisis we're going to create alpha. That's what it not means, but that's what it sounds like. And so I do think that is something that we as an industry maybe need to address a little bit, so there isn't this automatic expectation of positive performance from a trend follower every time the S&P goes down by 3 or 4%. One way that also came up, one way that maybe we should start educating investors to look at it, is maybe to look at that particular environment if they're trying to have some kind of protection to equities, and we understand why that is to think more about it as some kind of put option where you won't make money initially. It's not an at the money put option, it's a out of the money put option to some extent, where clearly our systems have to have some time to adjust and reset the positions before we can have any expectation of delivering some outperformance. And I also agree with what Jerry says, that of course our hope and aspiration should be that we should be a much bigger part of any portfolio for what we do. And it has been highlighted also in an interview I did earlier last year, I think it was, with another really big pension fund in the US that have to a large extent embraced trend following. I mean, put in, I don't know, $8, $9, $10 billion into trend following. So a very large commitment within their risk mitigation part of their portfolio, which makes a lot of sense. But they also put a large amount of money into long-dated treasuries, U.S. treasuries, as part of this risk mitigation portfolio. And that is the one thing. And I think a lot of people do that to some extent. They have bonds to offset any wobbles in equities, because it's been working well for the last 10 years. The correlation between equities and bonds have been kind of perfect for that purpose. But I think we have to also think about the risk that particular offset won't work. With rates being so low as they are generally around the world, maybe not in the US right now, but generally around the world. And another podcast episode that's going to come up that I will also advertise now is a great discussion between a couple of really interesting volatility guys. Chris Cole, which many people probably know, was part of that discussion. Dan Stone was another one part of that discussion, and Matthew Sargason, the CEO of AHL, another very well respected trend follower. So fascinating discussion points, I think, in general. And as Jerry said, I mean, I hope we will have a bigger place in people's portfolios going forward.
I thought you were going to say something slightly different, because I know that I read sometimes in Twitter and these panel discussions that clients are, or in traders who are trying to say something negative about long-term trend following will say it's really a shame that the CTAs, the trend followers, have become more correlated to the stock market. They're making money on the upside. This is not what we want them to do. So I think it's kind of ironic that my solution to this is more stocks, whatever it takes to get inside as a business person. Let's get inside these portfolios of that's mostly stocks or bonds, and let's provide crisis alpha.
Sure, but you're saying more stocks, but you're saying and long and short. And I think it's the and long and short that is so important in that discussion, because I couldn't agree more that the long only versus a portfolio of stocks on the long short side, long and short, not long short, but long and short side as a trend follower makes a lot of sense. I mean, it really does.
But you might have to have a managed account where the client says, I get it, I love it, no shorts. Just go flat or try and follow on the long side. So whatever it takes. One of my big lessons of my career is that I have not done a good job of balancing my passion for doing trend following, what I consider to be the right way, but that needs to be tempered by business. And so AUM.
Yeah. I mean, it's sometimes you can't get people to do exactly how you think it should be done, but if you can just move them a little bit in the right direction, that's a good start. And maybe over time, they will end up seeing it like we do. We can certainly hope. Let me run through some numbers. Now, these numbers, incidentally, Thursday evening was, of course, the end of January. So these numbers will be the January numbers. Friday was, I think, overall a quiet day, even though we had non-farm payrolls and all of that good stuff from the US. But I don't know, overall probably maybe a slight negative day for trend followers. But anyways, as of Thursday, that means January numbers, the BTOP 50 was down 1.83%, SocGen CTA index down 1.99%, the SocGen trend index down 3.25%, the SocGen short-term traders index down 1.71%, and the bridge alternative index, the flat fee index, down 4.2%. So clearly not a great start to the year, but let me just remind you, last year it was the complete reverse. Everybody was high-fiving after January, thought that was fantastic. Turned out the year was going to be a little bit more tricky than that. So maybe this year will also be the reverse of what January suggests. Anything you want to add? I mean, we've had a good long conversation today. And we're going to look a little bit more on the article from Hedge Nordic for next week, maybe, and have our own comments for that. Anything else you want to add before we finish for today, this week?
Well, I miss not seeing you guys in Miami, and I'm glad you went, and thanks for the report back. And it's always good to go to things like that and have the fun dinners and the interactions with our peers and our colleagues.
On that note, Jerry, you know that the next big conference coming up, that's actually going to be in Monaco this year. And if we can persuade Moritz to attend that one as well, I will be there. Then maybe we will have to meet you in Monaco. Sounds very glamorous, doesn't it?
Yes.
What about you, Moritz? Is before the jet lag hits completely, anything you want to add?
No, I think we're good. We covered a lot of ground today. And looking forward to a quiet Sunday afternoon now. Happy trading.
On that note, we're going to wrap up this week's conversation. Hope you enjoyed it. Keep your questions coming. They are fun, they're good, and they are very useful, we find. Just send them to info@toptradersunplugged.com or send us a tweet. And if you want to give something back to us, all we ask for is to share this podcast with just one like-minded friend. That is certainly going to help us. From Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.